Hello, chart watchers, and welcome to Market Watchers Live with Erin Swenlin and Tom Bowley. I'm your host, Tom Bowley. Today's show is being recorded, so you should be able to play back any or all of Market Watchers Live at your leisure. If you're unable to attend the show live, you can now go to www.stockcharts.com/webinars. Follow the link to Market Watchers Live and play back the show. Each show will be archived until the next show begins, so you will have roughly 24 hours. If you'd like to review an older program, you can now go to our YouTube channel or you can find us on Facebook. During today's show, please feel free to submit ticker symbol requests, questions, and comments using the chat window next to the video player. Later in today's show, Erin will provide me with stock symbols from your questions, and I'll use those requests in the 10 in 10 segment at 12:50 Eastern Standard Time, where I'll attempt to annotate 10 stocks in 10 minutes. Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. If you want to be part of the show, you can reach us right here via our chat room or Twitter. Our Twitter handle is at Market Watchers Live. That's at MKT Watchers Live. As you leave today's show, we'd love to hear back from you. At the lower right-hand part of your screen, you'll see How'd We Do area. You can simply click on that link. And it'll take you to a very brief question and survey where you can let us know what you think of the program and anything we can do to improve the show. For those of you joining us for the first time today, welcome to the show. We are glad that you've decided to join us. And for our regulars, welcome back. Just a couple of quick announcements before we get going. We do have Tushar Chande with us today, so it's a very exciting day on Market Watchers Live, and we will be hearing from him in just a couple of minutes. Tomorrow, Greg Schnell will join me as Erin will be unable to be available for the show. But Erin will return on Friday to host a segment on the DP models, so the decision point models. If you're interested in how those are calculated and so forth, Erin will be here to provide you a lot of information on that, so you want to make sure you're available on Friday. Then on Saturday, Greg Schnell and I will host the latest Stock Charts Outlook show, and that will be airing at 11 a.m. One thing about that show is that the stock market's closed. So it's always good to kind of sit back with the market closed and take a look at what's happened, especially in 2017, and maybe some of the things that we're looking at as we head into 2018. So a lot of good stuff coming up there. But first, I'm going to go ahead and bring in my co-host, Erin. How are you doing this morning?
I'm doing great, as usual. Good. A little bit of allergies going on, though. We have really high winds going on here in Southern California. Lots of windy gusts, but the temperature is not as cold as it's been. So,
that's a good thing.
Yeah.
Yeah, and it's Wednesday, and of course, we're always excited on Wednesday because it seems like we have a lot of guests that come on Wednesday, and today is no exception. We have Tushar Chande with us today, and we're very excited to have you on board with us. How are you doing today, Tushar?
Oh, good morning, Tom. Good morning, Erin, and good morning, everybody. And thank you so very much for inviting me here today.
Yeah, I think it's going to be really interesting. You know, everybody gets to hear from Erin and I just about every day on things that are taking place in the market. So it's really good to bring in various voices at Stock Charts to let everyone kind of, tell everybody what they're seeing in the market and how they look at the market. So I think it's great that you have an opportunity here to come on today and be with us, and we'll see where we differ and where we agree. So it'll be really interesting. And we're going to have Tushar coming back here in just a few minutes. He'll join us and go over a number of the things that he looks at probably in the next 8 to 10 minutes or so. But before we get into all that, I know, Erin, you've got the agenda for today. You can share that with everyone and give us our first market update.
Absolutely. So today, like Tom was saying, we do have Tushar here, so we're going to spend most of the day with him. I mean, we have somebody very important here and definitely someone we want to listen to. So we're going to hear a lot from him, but we'll start off with our talking technically, give you some of the major news going on in the markets right now. And then, as I said, Tushar will come on with us. We'll take a small break to do the 10 and 10 to 1. And our very first symbol we're going to look at is Qualcomm. Came to us in email. And then after that, we'll take some of your questions and put them out there for Tushar, and you can you'll have all of these answers from what was going on in the live chat box. So that should be fun. And then, of course, we'll finish with mailbag if we have time and wrap it all up for you. And with that, I'm going to go ahead and get right into our very first market update. All righty. And here we go. All right. Not the most exciting day today on the market. We are seeing some choppy trading right now, but mostly unchanged for the Dow and the S&P 500. NASDAQ, same thing, still mostly unchanged. Not the most exciting Wednesday we've ever seen. Russell 2000, though, small caps are struggling and they are down. We can see they're now getting ready to test some intraday lows. Wilshire 5000 is lower as well by just a hair. And we can see that Treasury yields gap down, so currently reading at 23.23. UUP is rallying nicely with a gap up, and it is continuing higher. Commodities, however, are really struggling today. Gap down, making new intraday lows, and likely affected greatly by what's going on with USO, with oil right now, which did gap down and is also testing intraday lows right now, reading at 11.25 for USO. Gold is down. Looks like we might have a possible little double bottom here, so we might see it get to the positive. But if we continue to see the dollar doing very well, it'll be very difficult for GLD to execute a double bottom right now. So I am not looking for gold to do much in the way of a move upward, but currently GLD reading at 120.03. Volatility index is, mostly unchanged. We're reading at about 11.22. Advances leading declines by a small amount. Let's look at our market summary and get a feel for what's going on in the various sectors and industry groups. And we can see right now, major indexes, utilities, and the NASDAQ 100 are the leaders right now, with the NASDAQ 100 actually up over 0.25%. Again, small caps struggling today. Russell 2000, S&P 600, the laggards of the list. Sector spiders, technology is making a bit of a move, as well as utilities, and we saw that as far as those indexes above. Energy is struggling the most right now, down 1.31% at this point for XLE. Definitely a difficult day for energy. Not surprising when we saw USO down as it is. Computer technology, utilities are leaders as far as the industries are concerned. Not a surprise given the indexes that are leading. And again, oil, natural gas, and as well as gold all lagging. Oil services down 3.33% right now. Very difficult for that industry group today. All of our international ETFs are reading lower at this point, except for Switzerland. Switzerland is up slightly. And as far as the laggards are concerned, China and Taiwan, South Korea, all three getting hit very hard, with China ETF FXI down over 2.5% right now. And that's all I have for our first market update. So I'm going to send it back to you, Tom, for some interesting news out there, I'm sure.
Okay, let's take a look at a couple things. First, I'm just going to pull up the 10-year Treasury yield because, again, I like to see what's going on in the bond market, especially after we get some economic reports out. We did have, a couple out this morning. The ADP employment report came out a little better than expected, 190,000 versus 186,000. But, of course, traders are looking ahead to the government non-farm payrolls, which will be out on Friday morning. I think that's going to be the one that everyone's really focused on. But still, it was good this morning to have a ADP employment report out that was slightly better than expectations. Q3 productivity was a little bit less than expected. However, it was up 3.0%. Market was expecting 3.2%. So you got a little bit of positive news, a little bit of negative news, and the Treasury market was being bought today. And as treasury prices go up, tells us a couple things. Number one, it tells us the yields are going to go down because there's always that inverse relationship there. But it also tells us that traders are just a little bit nervous. And so I thought what I would do is show you the VIX, which really started, it bottomed back toward the end of November, as you can see here. And we've been in this uptrend for better than a week now to the upside. This is probably about 7 or 8 trading days worth of candles. And you can see we just seem to slowly be working our way up. And the reason I think this is kind of significant is that when you look at the S&P 500, normally we see a bottom in the VIX when the S&P tops. But you actually can see that the S&P didn't top until 2 days ago. So again, if we flash back to that VIX, you can see that the VIX bottomed and started rising toward the end of November, even though on the S&P 500 we didn't hit the high until the beginning of December. So it was already just showing us that the market was growing a little bit more nervous ahead of this selling. And now we're seeing the selling. And of course, technology has taken the brunt of it. The XLK has really been hit hard. It's trying to carve out a bottom here around 62 or so on the XLK. You can see the 50-day moving average coming up from underneath. And you also have the top of gap support right around the 62 level, maybe just a tad below. So as this negative divergence continues to play out, and that negative divergence is based on higher prices with a lower MACD. So it's just telling us that price action's going in one direction, while the relationship between two moving averages is actually diverging and going in the opposite direction. The short-term and longer-term moving averages are getting closer together. So it's just an indication that momentum is slowing a little bit. Price momentum is slowing. But not only are we seeing price momentum slow in technology, but check out the breakout and the failure to hold the breakout, and then the failure to hold the rising 20-day moving average. These two candles came within a span of 4 days, and both came on heavy volume. So it's not just price momentum slowing, but we're also seeing that volume is starting to turn a little bit more bearish here as well. So I do think that I think there's going to be a critical test. Maybe we're starting to bounce successfully off of that test, but I'm kind of watching this gap support zone just below 61 up to around 62. And so far we're bouncing off the top of it. Historically, we are about to enter a seasonal period in December for about a week. That is not so bullish. It's actually kind of bearish. And so the seasonal pattern's kind of lining up with what we're seeing technically. And so the next week or so could be pretty difficult. The last thing I want to look at real quick, because I do want to get Tushar in here and give him a lot of time to discuss with you how he looks at the market. But in my blog today, I just wanted to go through a couple of things. Here was the NASDAQ 100. This is a 2-hour chart that goes back 6 months. So you can kind of see this nice uptrend that's been in play. And you also can get a feel for the more parabolic type of move that we've seen over the past couple of months, especially off that late September low up to where we just were at the end of November. That is a huge move where we ran up probably at about 10% or so in 2 months. That's a really strong advance. So we have to keep that in perspective when we start looking at these pullbacks and not get too crazy about the pullback that's taking place. However, we have to respect this pullback and note that there are a few different support levels that I've highlighted here. One, the first one being at the mid-November low, just below 62.50. Then you can see the first, after we gapped up here, the first reaction low was down around 6,200. And then, of course, we get down here to the top of gap support and price support, which comes in just above 6,100. So this lines up very similar to what I was just looking at on the XLK. And, of course, that is the technology ETF. And the technology group really does lead the NDX, the NASDAQ 100. So all of it kind of fits. From a more intermediate term perspective, I'm watching this trend line, this rising trend line that has been holding since the early July low. And that would suggest maybe a move all the way back down to test the top of that gap support right here, along with what used to be price resistance. Now it becomes price support. So I think that 6,100 area will be kind of interesting. I did also show you the channel this morning in the blog on the XLK. You can click on these charts and just get an idea of whether or not we're continuing. So even though right now we're seeing that the technology sector is up, and keep in mind, it was up yesterday really nicely and then turned back down. So we are up early, but the question is, can we get enough strength to break this downtrend channel, or are we simply going to roll back over and maybe move back down into this gap support zone? So those are some things maybe to consider. In the current outlook, I wanted to step back and take a big picture, because everyone's getting so caught up in this technology move to the downside. Let's keep things in perspective. First of all, the technology ETF has been has been really the most solid leader throughout this bull market. And even though we've been weakening recently, over the past year and a half, actually almost 2 years since this began, you can see we've got a really strong uptrend that's been in play. And over the course of the last year or more, we keep testing, or occasionally we test, this rising trend line and the 20-week EMA, but we do it successfully and bounce off of it. We still have on the XLK another couple of dollars to the downside before we test that rising 20-week EMA, which has been the more solid longer-term support. So the daily weakness that I was pointing out seems to kind of line up with where we could be going on a weekly chart as well. So I wouldn't really grow overly concerned unless we started to break on the weekly chart. I think that would suggest maybe some more technical damage that we'd have to deal with. So anyhow, just a few things I wanted to comment on. I don't want to take up any more of the time, though, because I do want to bring in Tushar Chande. He has a PhD, an MBA, 2 decades of experience trading futures markets. He's developed many breakthrough technical indicators, which are very popular, and is the author of many books and scientific papers. In addition to his blog that you may follow here at stockcharts.com, you can also follow Tushar at etfmeter.com or at researchgate.net. And with that, I'm going to bring Tushar into the show. How are you doing today, Tushar?
Good morning, Tom, and thanks for a nice introduction and all the nice summary and roundup of the market so far.
Well, I know you do absolutely great work, and I'm thrilled that you are here on the show, because I think everyone else, many of whom probably are not familiar with you, are going to become a lot more familiar, and you have a lot of great information to share. I don't want to take up any more of your time, so I'm going to let you just take it away and go.
Good morning, everyone. Let's get this ball rolling. What I plan to do is run through a few slides just to give you a little sense for what's happening. And then what the topics are for the day. And once we do that, then I want to encourage you to ask as many questions as possible. So I'll try to run through them fairly at a good pace, but be happy to answer any questions as they come along, right? So the first, so the headlines, the topics really are to talk about the Chande trend meter.
Hey, Tushar.
Yeah. Oh, do you want me to share?
I want to have you go ahead and grab the screen,
Hold on.
if you can, so that they can look at your screen. The other thing, while you're doing that, I just wanted to mention to everybody that Erin and I will be watching the chat room. So if you have individual questions as Tushar goes along, feel free to type them in there, and we will try, as best we can, to pass those questions along as Tushar goes through his presentation.
So I hope my screen's going out into the big wide world. Okay.
Yep, you're in great shape.
Excellent, thank you. All right, so a little reset here. We'll start by talking about the trend meter, which I think is a tool that's very useful and powerful that I would like you to get a sense for. And then Erin had asked me about how we could use these things for sector rotation and market momentum. So I will show you a few slides just to give you a little overview and a sense for how these things can be used. And then eventually, I hope we can answer lots and lots of questions. So that's where we are. All right. So the trend meter is really answering the question, is this market trending? So if you were to eyeball a chart, this is like eyeballing a chart, but converting it into a number. And the question is, how strongly is it trending? So the main thing to remember is that this is absolute trend strength as opposed to relative trend strength. And to be honest, it's just been born from years of experience and frustration, because this is a question that is difficult to answer, has 1,000 different answers, and this is my attempt to quantify it. Okay, so what are the design challenges? The first design challenge is what indicators to pick. So since I wanted to talk about momentum, I've picked a lot of different momentum indicators. The really hard problem is, how do you weight these indicators to get a consistent scale? So I wanted to scale from 0 to 100, So the problem is how do you weight these things so they always give you a number between 0 and 100? And then the question finally becomes, how sensitive should this thing be? How quickly do you want it to respond or not respond? And since I wanted to do trend following, I wanted something that was somewhat slow, but not like real slow. So you can imagine that there are like a million choices, and depending on how you've been sleeping and what you've been drinking, you might make a different choice when you're part of the design. So here's an example of Nectar, which kind of illustrates the problem and the solution nicely. So Nectar was, the lower panel has the CTM. You can see there are different colors going from bright green above 90 to, say, pink below 20. So the left-hand side of the chart, you can see that the values were below 20 because it was trending low, trending down. And then whatever new information came into the market convinced the buyers to come in and prices started rising. Eventually, we had this massive breakout, and you can see that the CTM went above 90 and stayed above 90 for the duration of the move. So clearly, the scale is from 0 to 100. When it's trending down or trending low or trending downwards, it's below 20, maybe close to 0. And if it's moving up very strongly, it's near 100 or above 90. So very easy, eyeball the chart, give me a number. The next chart shows you the application of the CTM to 4 different timeframes for the Dow 30, looking back over the last few months. So on the upper left-hand corner, I have a 30-minute chart. Then next to it, I have a daily chart. In the lower half, I have a weekly chart and a monthly chart. And you can see that the CTM values are all different, and it scales very seamlessly from one time frame to another. And this is a very, very useful and very, very powerful feature. And why is that? Because if you were to ask 2 technicians to eyeball a chart, as soon as you change from, say, daily to weekly, they're going to see a whole bunch of different things, and they're not going to weigh the different indicators in the same way. Whereas because it's a computer, it weighs everything consistently and seamlessly changes timeframes, and it means the same thing. So a value of 80 on the daily means the same thing as 80 on the monthly and 80 on the 30-minute chart. So this is a really dynamite and powerful feature and an important tool, important way to use the tool. So just to summarize, you can use CTM on any time scale. It does the same thing and means the same thing. And this is a lot harder to accomplish than you might think in the real world. Okay. So what kind of trading strategies can we use? We can have trend following or momentum strategies and counter trend or value strategies. So when it's strong, say above 80, and you want to be a trend follower, you want to buy that object or consider buying the object. Conversely, if you're a counter trend or value person, you'd say, I'm going to think of selling this thing because it's too strong. The reverse is also true. If CTM is weak and below 20, then that object is a candidate for selling or shorting. Conversely, if you're a counter trend player, you would consider buying that object. So a variety of trend following and momentum/value strategies are possible based on what the CTM is doing. And the important thing is that you're applying many different indicators in different time frames and getting a single number. So you can imagine that it makes it very easy to compare across different markets or trading vehicles.
Hey, Tushar, can I ask you a question?
Go ahead.
When you look at these readings and you say, like, for instance, a trend follower, would buy when it's above 80, when you look at it visually, it kind of looks like an RSI. But, an RSI, of course, 70 or 80 means it's overbought. Is this telling us simply that it's a strong momentum, or is it telling us that the security is overbought when it's above, up in the 80s?
First of all, RSI is a very, very small part of it, even though it may look like the RSI.
Okay.
And if the market is trending, which is what we want, you know that the RSI can remain above 80 forever or for a very long time or much longer than a few days. Conversely, it can stay below 20 for a very long time or many weeks or months. And if you look at, for example, if I were to just scroll back to the Dow chart, the lower right-hand corner, you can see that it's a monthly chart and the CTM has stayed above 90 for many months in a row. Mm-hmm. So I hesitate to use words like overbought and oversold because they only make sense when the market is going sideways when the market is trending, overbought and oversold don't mean anything, because it can remain overbought for a long time or remain oversold for a long time, where the time obviously depends on whether you're using daily or weekly or monthly. So I would hesitate to use words like overbought, because that implies that it's going to come down right away. It doesn't have to come down right away. And even if you look at the RSI, it's quote overbought. You can quote relieve the overbought condition if the market goes sideways. So the value of the RSI above 70 does not predict the amplitude of price movement required to relieve the so-called overbought condition. So I think it's fundamentally a disservice to constantly say something is overbought. The correct answer is it trending? Because if it's trending, it can remain overbought/oversold for very long periods of time. And as on the screen, you can see the monthly chart or the weekly chart, for example, for this entire move, going back to February of 2016, the CTM value has stayed at a very high level for this entire rally. So if you said that, oh, it's overbought, I shouldn't buy, you would have missed the entire rally. So I hesitate to use words like overbought or oversold. The only thing that matters is it trending, and is it trending powerfully? Because then you can use a trend following strategy. And things like overbought or oversold are labels that are not valid when the market is trending strongly.
Okay, good.
I got a question that's sort of follows in that.
Go ahead.
It says, is it reasonable to use diagonal trend lines with the trend meter, or rely strictly on the horizontal support and resistance levels, those color transitions, which I think is pretty much what we were discussing.
Right. Yes, you can use them if you want, but I would prefer to just use the horizontal trend lines, because again, what happens is, suppose you draw a trend line and it breaks a trend line. Well, what does that mean? Is it going to go all the way down to 0? Not necessarily. It could just go down to, say, from 90 to 80 and then go back up to 90 again. So, I think the horizontal lines are less controversial, require less trading, less stressful, depending on how you want to look at it. But on the other hand, you can use a longer term indicator for shorter term trading. So if you want to use trend lines, I'm not discouraging it. It depends on how you want to trade it. I'm just saying that the horizontal lines serve the design goal of making it a trend following tool. But as I have said, you can use counter trend ideas with the CTM as well. Okay, any more questions?
Excellent. We have some kind of some general ones, but I think I'll save those for after.
All right, excellent. So in terms of the takeaways, CTM is very simple and very powerful, because it gives you a single number, and the value of that is enormous, because you can change time frames and you can come back tomorrow or come back a week from now, you'll get the same number. Whereas opinions, unfortunately, they might not be exactly the same a week from now. Anyway, it changes consistently across time scales. That's super important, extremely valuable, especially if you're a big institutional trader and you got this perpetual portfolio that's going to go on forever. You need consistency. Then, as I said, you can use it for trend following or counter trend, and it's really ideal for scanning, ranking, and screening. It's objective. It's not a matter of opinion. It's going to stay the same 6 months from now, and so it's just a dynamite tool. And basically, you can piggyback on my years of having my finger in the blender, all the troubles and tribulations of trend following. All right, so those are the takeaways. And we'll do a slight change of pace here and talk about sector rotation. That is an application of the CTM to sector rotation. Both Erin and Tom were interested, so I presume the big wide world is out there is also interested. So what I've done here is I've simply put the major sectors and indexes into a chart list, plug the chart list into the scan engine at stock charts, and said rank by daily Chande trend meter. So I have, so you can't really see the numbers, but the extreme right-hand side has daily values for the trend meter. And of course, for some people that may be too volatile, so then we can replace that with weekly values of the daily trend meter. So all we're saying is rank these X number of sectors or markets or ETFs or stocks using either the daily CTM or the weekly CTM, and let's see what it shows. And you can do that very easily with the scan engine. And all you need to do is you can put whatever conditions you want, and this at the last bit add rank by Chande trend meter. So those 5 or 6 words will unlock the magic of Scan Engine for you. All right. So this chart shows a plot of the sector daily trend strength. So the vertical axis is the trend meter. If it's say it's below 20, I call it 1 star for ease. It's trending down or trending down very strongly. If it's above 90, I call it 5 stars, trending up very strongly. So if you look at the left-hand side, we have things like XLY, XLF, financials, discretionary, and both types of discretionary, consumer discretionary, consumer staples, and then the Dow and the S&P, and then all the way on the right-hand side, you have technology, healthcare, and the dollar. So clearly this is telling you that the indexes themselves are very strong, the financials are very strong, for example, and the technology is weak. So you've captured market rotation, but we've put this on a horizontal chart for the moment. Now we can do the same thing with the weekly chart. And obviously the weekly chart will bounce around less because it has more smoothing. The story here is more or less the same. Again, the vertical axis goes from 0 to 100. 100 means it's trending very strongly. 0 means it's trending down very strongly. And 100 means it's trending up very strongly. So anything above 90, you're in Fat City. You got Dow and the XLY and the SPY and the industrials and the financials trending very strongly. To the right-hand side, you have energy trending down or just only moderately, and the dollar being very weak. So again, we've looked at the relative performance and the absolute performance, and we stretched it out on a horizontal line, right? But if you remember, if I go back a couple of tables up here, this was on a table. So one column here that you can't see is a scooter, and the other column over here is the trend meter. And the scooter gives us the relative performance, and the CTM gives us the absolute performance. So what we can do is we can take a difference from the SPY using that as our 0,0 reference and plot something like this. So here what we've done is the horizontal axis represents the difference in the daily scooter value. So this is difference in relative performance. The vertical axis is the difference in the daily CTM value. So it's a difference in the absolute strength. The chart, what does the chart look like? And at 0,0, you have SPY. So everything to the right tells us it's stronger on the scooter. Everything on the left tells us it's weaker than the scooter. Everything above tells us it's stronger than the SPY on an absolute basis. Everything below the SPY on the vertical axis tells us it's weaker than the SPY on an absolute basis. So now here you've got your spinny things that you guys love. Anything in the left-hand quadrant is weak. Anything in the upper right-hand strong quadrant is much stronger than the SPY. And it'll keep going round and round in circles. So if you want to do sector rotation, you have your rotation about 0,0 right here. And of course, this is with daily data. So we've got to convince Chip to put this on the stock charts website. And here we go. And we can do the same thing with the with the weekly data. Again, same thing. The horizontal axis is the difference in the daily scooter values. So difference in the daily relative strength. The vertical axis is the difference in the weekly CTM value. So in the weekly absolute trend strength. So you can think of this way, we're comparing price performance on the horizontal axis to the chart pattern on the vertical axis. So it's your ruler versus the eyeball, if you will. And again, you can see anything in the lower left-hand quadrant is much weaker than the market. Anything in the upper right-hand quadrant is much stronger than the market. And you can see right now, only the Dow is really much stronger than the SPY. And of course, XLI, XLF are also stronger. So this is the same information as we have on these tables, but we can plot them as a horizontal in a bar chart, or we can replot them as a 2-axis difference in scooter, difference in CTM, and see the thing spin around. So for all of you who love sectors and say, I want to be counter trend and buy a weak sector, maybe I'll buy utilities or bonds, or you want to say, I only want to buy strength, maybe only I'll buy things in the Dow index. So it just depends on what makes sense to you. But the tool is there, the tool is powerful, the tool is objective, and you don't have to think about it. I love it when I don't have to think about things. All right. And lastly, I'll finish this segment by saying that you can plot the relative performance directly. So here I've plotted the ratio of XLK to XLF, so technology versus financials. And in the lower panel, so it's the ratio of XLK over to XLF, which means when technology is strong, the line should be going up. When technology is weak, the line should be going down. And we can see that very easily here. And you can look at the CTM below. Right after the election, the financials took off. So the ratio was down in the mud. It was in the red or the pink area. So it was trending lower, i.e. technology was weaker than financials. And then we had the strong rally and then the financials stumbled because whatever, people were not sure they were going to ever get a tax reform done. So you can see that the CTM moved up. It was trending up in the 90. You can see technology was strong. And then after that, we sort of had this more sideways move. And if you look at the last few days, we know that there's been a big rotation out of technology into financials. You can see that the line has come down very strongly, which means that financial was strong. And you can see the CTM has come down. And now we're down in the red region, which tells us again that looks like the move was so strong and so swift that we were able to push the CTM all the way from, say, above 90 to below 20. So that gives you a sense for whether can this thing respond quickly or not. So another example of using CTM, but here instead of doing it on a spreadsheet, we've directly taken the ratio of two objects or two ETFs, two stocks, and done it that way. And again, the interpretation is the same. 80 means the same thing, 20 means the same thing. And it's really consistent, really easy to use. You don't have to worry about time frame. You can stick the weekly in there or the monthly in there, and you just interpret it exactly the same way all the time. So I really hope that you'll enjoy using this indicator. It's super easy, super consistent, and means the same thing. You can use apples to apples. You can, for example, the big cap ETF cannot be compared to the mid cap ETF. So a big cap stock at 80 might not mean exactly the same thing as a CTM, as a small cap at 80, so to speak, because they're different scales. But now you can compare a foreign index to a US index, or to a bond fund to a Pacific Rim fund, because everything is totally homogenized and we don't care what's underneath. We're just looking at the chart. We've converted into a number, and now we are off to the races. So very easy to use, and I hope all of you will use it some more.
All right, I have one question for you, Tushar, and I think this really covers probably a question a lot of folks in our audience are thinking, because we do have a lot of shorter to intermediate term folks. I mean, we also have a lot of long-term folks as well. But if you're looking at this maybe from a swing trading perspective, let's say you had X dollars ready to invest today, how would you use the CTM to identify good, solid trading candidates? Is that a fair question?
Okay. First of all, I used to be a money manager for a long time. So if you remember, I put past performance is not necessarily indicative of future results.
Right.
So I always start with that. What I would like to say to you is that you have to look at the chart and say, if you're looking for a swing trading candidate and you want to buy a low, then you're clearly looking for a CTM value that's below 50, right? Because you're buying weakness and not buying strength. But if you want to buy a swing candidate and you think, I think this is going to start moving, all you have to do is shift to a lower time frame, a shorter time frame. And when it starts to move, you're going to see it in the CTM value. So if you don't mind, I'll go back to the chart of the Dow, because I think that kind of answers your question. If you look at the upper left-hand corner, you have this 30-minute chart. You see it rallied very nicely. You can see the CTM value speaking at 90. So if I were trying to trade a swing trade, and I think that this stock is a candidate, then I would say, well, first of all, on the daily or weekly, it has to be in the yellow region, so it is pulled back. Now I'm looking for a bounce, and I'm going to see the bounce on the intraday chart, say an hour, 1 hour chart, or a 30-minute chart, or whatever. But on the intraday chart, it's going to be a CTM above 80 or above 90. So I'm back to my above 80 being the critical criterion for me. But if you want to do a swing trader, you got to maybe use a different time frame. So that's how I would approach it. Does that make sense?
Yeah, I think too. And I'm just looking at that 30-minute chart, and I'm trying to figure, because I understand the question that's being asked, and I would kind of look at it the same way. I mean, first of all, you got a monthly CTM that looks very strong. You've got a weekly CTM that's very strong, a daily that's very strong, and then the 30-minute looks like, because we've been trending lower for the last couple of days, obviously we're seeing that CTM, move back more into like a neutral territory. But when I look back to like the 22nd and 23rd of November, I see that same type of pattern that maybe you're talking about, where you're getting a little bit of a pullback in the short term for a chart or a company, in this case, it was the Dow, but that overall from a daily perspective is very bullish.
Right.
And so timing maybe on a 30-minute chart, that makes sense to me when I look at it.
Right. So I'm back to trend following with a value above 80, but it's on a 30-minute chart, so it makes it a much shorter term deal rather than on a monthly chart, right? So I'm applying my principles consistently, but I'm now using a 30-minute chart or a 1-hour chart to get that swing move, because I know it's moving. I can see it going. I can see the CTM is high, but just that because you're looking for a swing, you have to shorten your time horizon. So using an intraday chart rather than a weekly or a daily chart.
Got it.
So I'm pretty simple and consistent that way. I don't like to use my imagination. I'd rather use it in the design of the object and then just use it, very systematically after that.
Okay.
I always like to say, if I had to think, I'm in trouble.
Maybe that's what gets me in trouble. I think too much.
Well, I've discovered the hard way that the more I think, the more in trouble I am. Anyway, that's for another dollar. Let's talk about market trend check. This is how do you apply a slide. Okay, so again, a little change of pace. I'm going to go away from the CTM discussion and just talk in general about, how do you think of markets? How do you think of, how do you apply some of these slightly different ideas, some of my trend following models, just to give something else to talk about. As Tom very kindly mentioned, I have a blog, and I put this up in my blog from time to time. And if you follow the history of the blog, one of the early blogs has all the details of the model or the models, so you can go back and look at it. But the idea is that, again, to go back to where we were a minute ago, sometimes you need a larger perspective just to kind of see what's happening in the market, and then it's easier for you to come down and do whatever. Just for example, some would say, oh, those are technology stocks are sold off. Great, it's a good time to buy technology stocks. Then I'm going to put them on a 30-minute chart. When I see the CTM rising on the 30-minute chart, whatever it is, NVIDIA or I don't know, IPGP, then you might want to consider buying it then. I'm not recommending it, but I'm just showing you the process of getting there. Okay. So here we have what I call the trend check carpet. There are 4 horizontal rows. I know it looks complicated. For each market, I have a strong up, a neutral, and a strong down. So there's a neutral region where you're flat, and green means it's trending up, red means it's trending down, yellow means it's flat. The top line is the short term, which is about a 25-day horizon. The horizon doubles at each step, so 25, 50, 100, and 200 days from top to bottom. Left to right, the number of stocks is Dow 30 all the way to NYSE, which is maybe 2,500 or whatever the magic number is. So you can see that except for the QQQ, in the topmost row, which is neutral, everything else is green. So we've had the sell-off, and so it's the effect of the short-term technology stocks, but the model is saying everything else is green. So if you're a trend follower, hey, it's up. Let's not worry about being overbought. Second, this is here I've just shown 4 things: bonds, gold, S&P, and dollar. Again, same time frame. So on the left-hand side, we have bonds. They're neutral in the short term. They're rising in the medium term, neutral in the intermediate term, and rising in the long term. Gold, you can see, is pretty much flat across the board. The stocks are rising across the board on all 4 time frames. Dollar is weaker in the short to medium time frame. It's rising in the intermediate time frame because we had this rally up above towards the 100-day moving average, and the long term is down. So depending on what kind of trader you are, you may be a long-term trader. It's still good to know where the other things are. So it might give you entry opportunities, on a different time scale. And then this is what I call the path of least resistance. So this is another way of looking at market breadth. So what I've done is I've looked at the Russell 1000 universe, about 1,000 stocks, and I've applied my trend following models, and I've asked the question, are they moving up or are they flat to down? So it's just a binary sort, and I've rolled up the numbers. So if more stocks are moving up, it's in the green. More stocks are flat or down, it's in the red. So right now, despite all the shenanigans for the last few days, it's saying that on the whole, at the 1,000 stock level, it's green. But there are more stocks rising than falling. So even though some tech stocks have taken a hit, by and large, on the broader market, the trend is still higher. So you can look at it at the index level in terms of price, or you can look at the component level, meaning each of the individual constituents, and roll them up. So again, we're consistently applying the same model across 4 different time frames. There's no opinion involved, it's straight number crunching, and we plot it out. And this is what the market is doing. You're looking into the market. It's like a market X-ray. What's the path of least resistance? It's up. But obviously, there's a time frame involved. And it's possible that the intermediate term and long term could be up, and the short term and medium term could be down. But that doesn't mean that the trend hasn't changed. It has changed. The long term trend could be up, but short and medium could be down. So there's always churning in the market. But right now, it's all up. And of course, if I change the underlying universe, I'll get different numbers and so on and so forth. But all I'm saying is there's a consistent way to understand and apply these rules to the market. That is not a matter of opinion. You can look at it across many different timeframes and synthesize this information, and not have to pay big bucks for Wall Street analysts. Okay, this is something I have on my website, what I call dials. So I've summarized lots of different information. Here I look specifically at the QQQ. The dial in the upper row center is the trend meter, that's 63%. To the right is a year ahead forecast. So the trend right now suggesting it's going to be up 24% on average with a plus minus 2% error. The lower two dials are giving you a sense for bulls, the strength of bulls versus strength of bears. You can see that the bears are weak, so it's bullish, but the bulls themselves have lost a little bit of their mojo. And that makes sense if you've seen the sell-off for the last few days. The two left-hand dials are medium-term allocation and long-term allocation. So medium term, you can see that the trend has changed, and we saw that it was neutral in the other chart. So I'm showing 35% cash if you're just playing defense. And on the long term, it's only about 70% invested. So this is a pretty conservative allocation, even in these strong trends. And you can see that certainly a 30% cash cushion would have been pretty nice the last few days. The same story on the analytics dashboard, but this is for financials, and you can see it's all green everywhere. So here we have some yellow, some caution because of short-term events or medium-term events, but here everything is pointing straight up. So it's very bullish. The bulls are very strong, bears are very weak. Perfect, that's what you want. Trend strength is very high at 95% or 95. We have a double-digit year-ahead forecast. The short-term and long-term models are both heavily invested. So this is telling you that strictly from a trend following point of view, the model is saying you should be all in. Now, of course, it doesn't mean that you should be all in. It depends on what your strategy is, but that's what the model is saying. And of course, it'll change over time. So if we come back in 6 months or 3 months, it could be different. So again, this is another way of saying that we can crunch the numbers and get insight into what's happening in the market by applying the models in a systematic and disciplined way. And of course,
we had a question about whether you've back tested any of the results on the CTM. Have you done any back testing?
Oh yeah, I've done plenty of back testing, and it certainly works. But now the problem you're going to run into is when you do a back test, you're going to have, say, a buy signal on 500 stocks. Are you going to buy 500 stocks? Maybe for institution. So by and large, it's just trend following. It's brute force trend following. I can give you examples where it's worked beautifully. I can give you examples where it does not, because that's how prices work. Prices can go up for 3 months and then fall off bed and never go higher again for another year. So it's not magic formula. It's just a screening tool. And all I can say to you is just put it on a bunch of charts and eyeball them. It's eyeballing converted into a number. But yes, I've tested it, and I can cherry pick the data and tell you it looks great. I can show you examples where it has not. It's like any other trend following model. You can get very good signals in a trending market, and certainly you'll get some not very good signals in a downtrending market. But by and large, it's very good at identifying the long-term or medium-term trend.
Excellent. I think that probably answered that question. Like I said, I've been collecting a lot of general questions.
Sure.
Ask you after our 10 and 10, because I know we're getting ready to do that, but feel free to go into the chat room and answer anything you might want to answer in there. And then we'll try and, when you come back, if you could sort of, summarize what you may have answered in the chat room, since not everybody is watching live.
Okay.
Yeah, I think that would be awesome. And we're going to go into the 10 and 10 and we'll get another market update, but that'll give you some time, Tushar, maybe to go back and look at some of the questions, because there have been a lot of questions that have come in the chat room. And then maybe you can come back and respond and try to respond to as many of those as possible after we get done with that next market update. Does that sound like a good plan?
Yeah, it's wonderful.
All right. Yeah, this is very, very interesting. And I know there were some comments that, this seems to be more of a long-term strategy, but I think that there are some pretty useful trading, shorter term trading applications, especially when you're looking at the different time frames like you showed earlier.
Yeah, anytime you're looking at a 30-minute or 60-minute chart, certainly you're looking at a pretty short time frame. And comparing that, a lot of people are saying that it's nice to be able to look at all of that on one piece of paper or one slide like you had, where you could see all 4 time frames and make some comparisons.
Yep. All right. Well, let's go ahead and move on to the 10 and 10. We're going to come back with Tushar here in just a few minutes. Let me go ahead and grab the screen, Erin. I do want to share with everyone before we get into the 10 and 10. I've got Tushar's blog pulled up here. It's Trend Check with Tushar Chande. So if you're actually looking for it and you go under the menu, All Stock Charts blogs, go down to Trend Check with Tushar Chande, click, and then you will have his blog. Just to find it kind of interesting, just a few days ago, you were saying to fasten your seatbelts, and certainly that was a pretty good article and timely. And then the one before that, you had indicated that back a few months ago, you had indicated a target of 2663 on the S&P 500, and that is almost exactly where we have gone to. So very interesting prediction there based on the trend meter. So anyway, some really good stuff. We're going to come back to here in just a couple minutes. But Erin, if you want to go ahead and get going with the 10 and 10, we can do that.
Let's do it. And we're starting off with Qualcomm. And the person who sent it in via email was talking about how it's, looking bullish in her opinion. And so she's thinking of getting in, but also maybe trying to figure out what ETFs might have Qualcomm in it or a larger share. I don't happen to know that off the top of my head, but.
Yeah, I'm not really a big ETF trader. I will occasionally trade ETF. So I know some of the companies that are in some ETFs, especially when it's an ETF that's only got a few large holdings, take up most of the ETF. But most of the ETFs I really don't follow in that way. So I would say, though, it's going to be in the NASDAQ 100, and probably some of the other larger cap type ETFs that feature technology companies. But what I would say on the chart is that, number one, we got this huge breakout on massive volume. I mean, when you look at these volume bars, there is no question that there's some accumulation been taking place in Qualcomm since the beginning of November. Even the move up, you can see that the MACD starting to roll over. So you might say, wow, we got some slowing momentum and some momentum issues. I'm not sure I would draw that conclusion, because as it continues moving up, and even though the volume has gone down, of course it had to. I mean, we're not going to continue to trade 80 million shares a day of Qualcomm. But even these volume bars, when you compare throughout the year, these are some pretty heavy volume bars as it kept going higher. So I am not looking at Qualcomm as though it has slowing momentum. So I've actually drawn this arrow in here. I want to see the rising 20-day moving average hold, which so far it is. And I would look for a return on Qualcomm in the near term back up to that 68.5 area to test the earlier highs.
All right. Next one is for our Canadian friends, XEG.TO.
Okay, well, I think we certainly found our resistance level on the November high. So if you come across here and connect these highs, I think you'll see they're pretty much the same area, same level. So that's going to be the level we have to get above. But instead of downtrending, we have now begun to uptrend. So we have a high here, higher low, higher high, higher low, higher high. And this pullback, I actually think as you get closer to this price support area, that it actually provides a pretty good reward to risk trade on the long side. So I like this uptrend. And even though we have been pulling back, I think anything down here in this 1160, 1170 area is not a bad entry from a reward to risk standpoint, with maybe a fairly tight stop around 1140.
All right. Let's see here. Okay, sorry about that. Next one I have is copper, COPX. We had some interest in that one.
Yeah, this one completely fell apart in what I was looking for. I was looking at the price of copper. Now, this is the copper miners, but the price of copper was in what I thought was a bullish triangle. And I'm going to pull that up. I'll come back and annotate this one, but let me just show you what I was looking at on copper prices. But off of this high, we had been moving lower here, and then also we had been moving higher at the bottom. So we were kind of squeezing. It looked to me to be squeezing. And then you can see yesterday we had this huge move down, 4.6% on copper prices. So that to me sets up things a little bit differently, because that now starting, at least it blows that triangle pattern out of the water. Now maybe it'll continue to consolidate and eventually break to the upside. But what I'm looking at here on the COPX, and let me just get this back in here. Okay. Let me annotate this and show you the support in terms of reaction lows that I'd keep a real close eye on. You can see that we had these two tails down here back in August, down at about 2350, maybe just above. And that is exactly where we are sitting on the COPX right now. I think this needs to hold. I mean, outside of that and maybe a little bit of support down around 23, this was a straight up move. So if you fail to hold support, you could simply just move right back down, kind of almost like a mirror image of what we saw to the upside as we moved up, kind of double top. Then we started losing these support levels. I don't want to lose this 23 to 2350 area on COPX.
All right. Let's see here. The next one I have is Skyworks Solutions SWKS. Kind of reminds me of Sealed with a Kiss, but I'm not seeing this as all that romantic as far as the chart.
Well, I like it only from standpoint that I'm seeing potentially a reversing candle, and this stock's been hit so hard recently. I know this is also on my strong earnings chart list, so I wouldn't be surprised to see a reversal. But here you can see was the last big low on volume. And after making the breakout on some pretty good volume at the end of October, early November, this stock has come crashing back down along with many technology stocks. And it's now printing a pretty bullish hollow candle. Again, I don't know if this hollow candle is going to hold into the close, but right now it's reversed quite a bit off its earlier low today, which was clearly below major support going back. And the fact that it's reversed and come back up above it, if it closes here, I would look actually for a short-term rally, maybe back up as high as that falling 20-day moving average. So I would be short-term bullish SWKS, but I have my stop on any close down below that 94 area.
All right. Next one I have for you is AAXN. And the question was on the weekly chart. They're seeing a possible descending wedge.
On the weekly chart?
Yes. I'm almost seeing a descending triangle though, which is bearish. So I'm not so thrilled with it. But I'm getting a PMO buy signal. So, it certainly would be on my radar.
Yeah, I mean, I guess, this one could be interpreted. However, I think Tushar said it best earlier when he's saying, you look at these charts and you kind of figure out in your head what you want it to be. And then all of a sudden you just go with it, and it can really, give you some false signals. I kind of agree. This downtrend needs to be broken. I wouldn't be too excited about holding this stock until I can see that break. You might look at this as maybe a wedge if you connect that closes, or as you were pointing out, Erin, maybe a triangle here. I would rather see an ascending triangle after an uptrend. So we got this uptrend in play, and we've been consolidating for a while, but the lows are holding, but the highs have been moving lower, which is kind of strange. Normally it'd be the opposite. You'd expect that we'd keep bouncing up against resistance, and then as we pulled back, those pullbacks would get more and more shallow, resulting in an ascending triangle. So this one gives me a lot of mixed signals. When I look back over the course of the last couple of years, the market's been going crazy, and this one's not able to break out. So on a relative basis, you got an underperformer. I wouldn't be in unless I see a breakout of this trend line right here. So maybe heavy volume and a move through 25 might be interesting, but until I see that, I'd have to probably just sit on the sidelines.
Okay. Next one will be Helmerich and Payne, which is HP.
Yeah, I wrote about this one, I think, in my Chart Watchers article.
Yeah, I got a really nice PMO reversal bottom that came in just before that, what I would say is that flag pennant that had formed before.
Well, I think when I talked about it, I was looking at the strength, the historical strength. And when you look at this stock, December over the last 20 years, December average is going up 6.1%. And look at these returns on average going in the first 4 months of the calendar year. This 5-month period is clearly the best 5 months for this stock. So I think I wrote about this as one of the 2 stocks maybe to keep an eye on from a long perspective in the month of December, because we were heading into this historical bullish period. So I actually like this pullback, and the tail certainly is a good thing. But I would maybe keep my stop around $52. So I'm going to just annotate that for you. But that recent low, and you can see all these tops coming in here. We finally broke out, volume picked up, and then we went down and we held. So I think that would be the level that I'd have to maybe make sure I keep a stop. I mean, you could do it close below the 50-day, but I think this is a more important price support level. So that's what I'd be watching.
Okay. The next one, I'm going to actually give myself a pat on the back for this one, but Intel, INTC, I'd written about a parabolic that had formed and try to give a little bit of warning right before that longer term decline back to the 50-day EMA.
Yeah, I was actually trading Intel, and I got stopped out on it recently. So I did not have the right call, but I do like this top of gap support reversal that we're getting right now on Intel. So right there, you can see we got a 50-day test. We're also potentially putting in a hammer right at the top of this gap support. So I actually, if I had to make a trade right now, I'd be long Intel and maybe use today's tail, any move below that as a stop. So I'd keep a fairly tight stop on it. But again, I'm looking at it from a much shorter term time frame. And my target would actually be the recent high up around $47. So that's what I would do. Now, my trade, I was looking for it to hold the 20-day moving average. And this candle right here, when it went down, took me out of my trade. So I took a small loss. And of course, the next day it was up. I remember complaining about that. But it has come back down with the rest of the group. But overall, Intel, I think, has been a really strong performer in the semiconductor space. And you can see the volume that came in from $43 to make this move to the upside. So it doesn't surprise me that we're getting a little bit of strength here. And I would expect it to continue.
All right. Let's see. The next one I have for you is USO. I actually wrote about this in my blog yesterday. So if you're interested in my opinion, it's in the Decision Point blog from yesterday.
Yeah, USO, I try not to do too much with. I've had not such great luck trading it over the years, so I really don't even trade it. I think we're in a nice channel to the upside, so I still like it on the long side. But again, maybe take that with a grain of salt, knowing my history with this particular trade. But what I'm looking at is something like this. It may not be perfect, but yeah, pretty close. But you can see that this trend or this channel has been in play now for quite some time. So potentially the problem is you've got room all the way down to about 10.5 or so before you hit that bottom trend line. That also would coincide with some pretty decent support. You can see a top here, another one over here, this breakout. Notice then that would provide support right near this trend line support as well. So if we do go back down, if you're looking for entry, best entry for me would be down close to this level, simply because I'd have a stop really tight underneath of it. But the overall uptrend to me looks like it's still in play, so I would remain bullish.
Okay. Next one's pretty interesting, at least as far as my chart is concerned. IEMG, which is the Emerging Markets ETF. And it looks like it's been pretty right on since mid-November, at least when I look in the thumbnail. A lot of island reversals that executed textbook style. And I'm looking at it, I could see a possible one shaping up, except that I don't like it came in under support.
Yeah, I got some mixed feelings. I do still think that we are in an uptrend, even though the action today is lower. I'm trying to look to see maybe a more significant support area, because you can see there we had some support. We're trying to go below that. But maybe the more recent low there. I'm talking myself into and out of this one as I go through it, which normally means I just want to stay the heck away from it if I don't see something that looks really good right away. The volume here to the downside is a little bit of a problem. Losing that trend line is a little bit of a problem. But we also went up with, pretty much unabated. We've had a couple of pullbacks here throughout the year. This has been a pretty nice move to the upside. I'm just going to say neutral at this point. I know that's a cop-out, but I don't really see anything that's compelling to me at this point.
Right. That's fair enough. Okay, the last one came to us on Twitter, and that would be NFX, Newfield Exploration. Testing some interesting support.
Yeah, that's exactly what it's doing right now. And I think that the level between 28 and 29 is really important here. I actually have an energy stock, not this one, and it's all the energy stocks are under some pressure today. So I'm kind of watching the level closely as well. Not on this one, but just the overall group. But here, when we made the first move to the upside, this was the reaction low, and then we broke out again. So that to me makes this low very important. And so we haven't broken out above this one, so I'm not as worried about this low as I am this one over here. So I'm going to say right around 28 and a quarter to 28 and a half. Really, it would be good to hold, because if that fails, I don't see too much support on the stock till it gets back down to about 25. So I'm cautiously bullish here on this pullback, but I would have my stop in place and tight.
All right. And that is 10 stocks in, just about 10 minutes. We're doing pretty good with it. At this point, though, I think I'll give everybody a quick market update. And Tushar, I hope you've been collecting all kinds of interesting questions to answer after I'm done.
Okay.
All righty. All right, so I'm going to take a look at our candle glance first and foremost. And as we can see, really no change right now on the major indexes here, with the Dow, S&P 500, the NASDAQ as well, all looking mostly unchanged at this point on the candle glance two-day chart. Russell 2000, small caps are getting hit. They're continuing a decline that started really yesterday, and the continuation is concerning, I have to say. Getting ready to go back down and possibly make some new intraday lows. You can still see Wilshire 5000 down slightly. Treasury yields gap down, but have been moving mostly sideways, lower at 23.21. Dollar gapped up, has continued higher, but looks like it's rounding off right now. May see just some consolidation coming in. I wouldn't expect it to fall right back down. Could see commodities getting hit rather hard, gap down. Although right now, over the lunch hour, it does appear that we're seeing some consolidation. And with USO, even a slight uptrend happening, but USO is still down at 1127. GLD is lower for gold, currently reading at 120.05. VIX is now looking a little bit unchanged almost from earlier today, but we can see it's reading currently at 1125. Advances leading declines. Let's go ahead and look at some of our scooter movers. First of all, top 10. I think it's interesting to see a lot of discretionary stocks here, with Coors, Michael Kors, Urban Outfitters, Gap, etc. Does tell you that, and probably due to the holiday season as well, that's where the highest ranked stocks are. And interesting, seeing discretionary really leading as far as large caps on the scooter. Big scooter movers today, DVA, Davita, Gap up and up right now. It looks like, quite a bit, 10% possibly. HRB, H&R Block, also having a great day. You can see with this why the scooter has moved to the upside 45 points in that stock chart's technical ranking. Also, top up, we're also looking at Salesforce, and it's been in a decline, so it's not a bad thing to start seeing that one moving back up with a nice scooter value. As far as our moving down, though, an HP we looked at earlier is right now lost 33 points on its scooter ranking, and RIG, not totally surprising here. Transocean, we're seeing quite a decline, getting ready to test some lows. And that's all I have for our final market update. And let's definitely bring Tushar back in here and see what questions he has to answer.
Thank you, Erin. I've jotted down a few notes, so I will just peel through a few of these, and hopefully we'll have more questions as we go along.
Mhm.
So one of the questions was, does the CTM use volume? And the answer is no, it does not. So, uh, I come from the futures side of the trading world where we never really use volume. So I primarily base my analysis on price only. And ultimately, we are trading price, not volume. So the CTM does not use volume in any way. And I've played around with volume, but I've never really found anything particularly fascinating or interesting. So I mostly just focus on price. So no, it does not use volume. Then the another question was, is how is the computation set up? The computation is really long to discuss or to remember, but I think that if you look at the help pages on the stock charts website, they do a pretty good job. As I said, the problem really is, how many indicators do you want to put on a page? So imagine if you have 1,000 charts with one indicator on each page. Hey, that's a challenge. Now suppose you have 10 indicators on each chart. You got 1,000 charts. How are you going to remember individual values, and then what happens tomorrow, and then next week, and so on? So it's sort of almost irrelevant in terms of what you actually have in there. What matters is how is it weighted and how does it work when you change time frames. And so the struggle for me was figuring out how to set the weights. And I think I've done a pretty good job of capturing important chart features as well as price action, price momentum, and I had something like this on the futures side, but then I had to modify it and change it quite significantly. Completely different sort of logic to make it work on the stock side. So the idea is, when you open your iPhone, you don't say, I'm not going to use the iPhone until I tour the manufacturing facility in China. You just kind of use it, and if you like it, you like it. If you don't like it, you don't. That's the way it is. Then there was some, wondering some comment about whether the rotational aspect would be similar to RRG. All I would say is that you should go back and revisit the last week's interview with Julius, which is I think on the YouTube and on your Facebook page, and carefully pass his comments and see whether after that you're still convinced you want to use RRG. And then in terms of the weekly CTM, some people have on some charts, if there's not enough data, you will not see values of the weekly CTM. So it's not that it can't be calculated, but it needs, of course, more data in order to perform the calculation. So you should be able to see it. And if you don't see it, it just means that for whatever reason, maybe it's a new ETF or a new stock or a new listing, and there's not enough data available to calculate it out. And then one of the questions was, could you use this as a leading indicator, perhaps for an exit strategy? And the basic question there is that what is your time frame, right? I mean, obviously you can generate signals on a longer time frame or entries on a longer time frame and exits on a shorter time frame, or vice versa. So if you draw a 2x2 grid, and if you write speed of entries and speed of exits, do you want to combine slow entries and slow exits, or slow entries and fast exits, or fast entries with slow exits, or fast entries with fast exits? And that just depends on how you want to design your trading strategy. And then obviously if you want fast and fast, you can use intraday data. Say if you want to have slow and fast, you can have weekly entries and daily exits and so forth. So you can use the CTM on a shorter time frame to make it a leading indicator for a trade that you have on a longer time frame. So you could have a trade that you're really running on a weekly time frame, and then you could use daily CTM on the daily time frame to give you some heads up or some leading sense of whether it's weakening. For example, if you want to add to a position, then you could look for weakness on the daily data in order to enter a position or add to your position on the weekly data, and so on. And since we know that it's very easy to change the time frame, it works very seamlessly. So once you can go intraday data, the possibility is really amazing, because you can use 2-hour charts, 1-hour charts, 30-minute charts. You can have all the flexibility in the world, and the interpretation stays exactly the same. So that's the beauty of it. And then there was a question of lag. Does it, yes, it does have lag. It does have smoothing because by definition, we have to have some smoothing because otherwise it's not possible to have a nice smooth indicator that doesn't change very, it's not too jittery. But again, because we have this ability to hop time frames, you can if it's too laggy for you, you just have to shorten your time frame. If it's too fast for you, you just have to extend your time frame. So again, you can imagine that as a designer, there's no way to anticipate the needs of every single trader, but because we can hop across time frames, it's no problem. You can adapt, or you can sort of look at the lag on the daily data, sort of calibrated versus what you would like to do. You can decide whether that's too fast or too slow for you. And if it's too slow, you can go to a shorter time frame. If it's too fast, you can go to a longer time frame. So it's simply a matter of adapting to the indicator. So if you are a discretionary trader, but you want something quantitative to look at, then you can use CTM as a standby, and you can say, oh, okay, here's another thing. Here's another thing I can look at it. And then there was a question on, does it have cyclic analysis? And the answer is no, there's no cyclic analysis. Now, this goes into now the question is it does have some moving averages, so you can think of moving averages as a cyclic filter. It's going to filter out stuff that's much shorter than the particular length. So but there's no explicit attempt to include cyclic analysis in the thing, in the design of the process. And then could you use there's another question on, could you use Bollinger Bands for breakouts? And of course the answer is yes. Again, I have if you look at my posts, I think there's one post early on that I talk about communicate more clearly with the market, or get closer in touch with the market, something like that. And that describes and discusses the models in detail. So you can see how I have set it up, and see how it can sort of help you formulate whether you want to use it for a breakout or not. And then the question was, how do I use it? I primarily use it as a screening tool. I have other screening tools, and I use it as an important part of my screening process. And then I have to decide whether I want to, hold something or not. And I try to be a longer-term trader. So the move in Boeing is an example this year of a trade that I would love to have done. I only did a very small portion of it, but that's an example of something you just buy and hold for a long time. You have to be really patient. There's lots of noise back and forth. The experts, like me, pushing you this way or that way. There's always so I think the real challenge in any of these trading applications is that you have to have a very clear idea of how you are going to trade, and then you have to live in a bubble that ignore everybody else. And that's easier said than done. I did that for 20 years, and I can tell you it's not that easy because there's always, it's very easy to be influenced by other people's opinions because, the human brain is not designed for trend following. We don't have the patience to sit over there and grind it out day after day after day. But, we've had some spectacular moves, and certainly IPGP was an example that we had yesterday on yesterday's show. Boeing is another example. Cognos is another example. There's so many of them this year because of the fabulous trend we've had in the market. And so the idea is that, pick your process and stick to it, and, whatever makes sense to you. And, CTM is just one tool that you can use in the process. And then,
well, I was just going to follow up on that, because I think that's really important. First of all, I think the CTM or any other indicator at stock charts, you really have to understand it. And what it means, and what you're looking for, and does it fit your trading style? Because when I asked you earlier about some of the, short-term trades, and I think even before we went on the air, I was talking about, I might hold a trade or a stock for maybe a couple of days. And all I heard was silence on your end. Because, everybody's different. Everybody's got a different trading style. But what I wanted to do real quick was just to grab the screen. I want to show everyone, because you mentioned this earlier, Tushar, that at stock charts, all these indicators have explanations if you go into the chart school. And here is basically the CTM. So if you go in and you just go into the search and just type in Chande trend meter, you're going to get the CTM, what we've been talking about, what Chande's been talking about throughout this show. And you can see that the calculation has influences from the Bollinger Bands, price change relative to the standard deviation. The RSI, that was the first thing I had picked up on. It just kind of looked like the RSI, and I've got an interesting chart I'll show you, and feel free to comment on that, Tushar, when you look at this. And then finally, the existence of any short-term breakouts, price channel breakouts. So with that, what I did is I took Intel. That was one of the 10 in 10 stocks, and I pulled up the weekly chart to give it more of a longer-term feel. I left the MACD up there. We'll just ignore that for now. But down the bottom, I took your CTM and I overlaid the RSI, the 14 RSI, and it's not exact, that's for sure. I mean, there's definitely a lot of differences based on some of the other influences that we just talked about. But there are times when they do kind of, look like one another, moving up and down. So I would say that the RSI, and you correct me if I'm wrong, but it seems like the RSI does have a significant influence in the calculation of the CTM.
Not at all. This is just
Okay.
an eyeball convincing you that it looks like the RSI.
Okay.
The RSI has much less than 10% weighting, so there are lots and lots of other things contributing to it.
Okay.
If I just wanted to use the RSI, I would use the RSI. I mean, but I don't actually use the RSI as it is. I use the what I call I take the inverse of the RSI, so I convert it into the buying power. And the reason I use that is you need some short-term measure of price activity, like there is a price thrust and you want to be able to capture it. But there are lots of other things going on. And you got to remember that you have to take a step back and ask, where's this thing coming from? It's coming from the price itself. So if you look at the RSI kind of looks like the underlying price. If you look at the CTM, it looks like the underlying price, because it is the underlying price recast in a different way and combined in a different way with other measures of momentum. And if you think of the CTM is trying to eyeball the chart, if you will, and say, hey, I find this pattern and that pattern and that pattern and that pattern, and we're going to weight this way, that way, this way, that way. And you can see that the rate of change of the CTM is not the same as the RSI. And of course, it looks like the price because it's coming from the price. And if you look at the RSI and the CTM, you'll see some similarities from time to time. But the weight of the RSI is quite small, because the problem with the RSI is that it only looks at a very small time frame, a short time frame, like 14 days or 14 bars or whatever, depending on your time frame. And also, it has really funky smoothing inside. Like if you look at the RSI values, they have the RSI was developed before there were computers, so they had to use shortcuts. And for its time, it was a really brilliant solution. And hats off to him. And I actually have an original signed copy of the book, of Wells Wilder's book. So it's one of the most interesting things I have. And so I have enormous respect for the indicator. It was done at a time when it was really, really difficult to do anything. Everything was done by hand. So it's a brilliant solution for its time. But I think it has a few quirks, and it is there, but it's a very small part of the CTM itself.
Okay, one thing that I highlighted here on this chart, on the weekly Intel chart, and just wanted to get your comments on this, because when I trade using the MACD and RSI and so forth, I use negative divergences.
Right.
And I'm just wondering, looking back at 2012 when Intel was making this move on the weekly chart to the upside, I noticed that the CTM was moving lower. Do you look at this because it is a momentum type indicator? Do you look at that as slowing momentum when you see a CTM dropping with price going up?
This is again a tough question. So my answer is no. I don't believe in divergences, because the problem with divergences is you don't know what the result of the divergence is going to be. Is the move after the divergence going to be a small move or a large move? And I'm a trend follower, so that means that I'm not predicting where the price is going to go. So if I take a divergence today, it might hurt me tomorrow, because I could have a divergence and the price could end up much higher. So the way I look at it is I have a trailing stop. The trailing stop is going to get me out. I'm going to give up some equity or some open trade equity to get out, but that's the price of my trend following philosophy. So I'm not trying to, so I understand where you are, and you could certainly make a case that there's a divergence, and so you could have a short-term trade, but then I would still be a trend follower by going to a shorter time frame, right? So for example, at that time, if I'd gone to a 30-minute chart, I have not seen that, I'm speculating, maybe the CTM would drop below into the red region and stay there. So if I wanted to, I could still be a trend follower, but on a 30-minute time frame and accomplish what you're doing. But I personally do not use divergence because I just don't believe in it, because I don't know what the result of the divergence is going to be. Is it going to be a small move or is it going to be a big move? And there's no way to know.
Okay. Well, we are running short on time, so I don't know. Do you want to give everyone, the your website where they can follow along?
Excellent. You can, of course, I have the blog on stock charts, so you can certainly look at that. You can look at my website, stockcharts.com and etfmeter.com, where I primarily have these summary tools and the data. But since you have CTM on stock charts, the other information is more interesting and useful.
What was the website? What was the website again, Tushar?
etfmeter.com, all one word.
All right, just want to show everybody.
Right. So you can see at the top that that's a summary just of the dials for the S&P 500. Tells you that on long-term basis, I'm only 70% in the market, even though and you see where the trend meter is, and my year ahead forecast is 15%. And one of the things that's really interesting is I have a commentary feature, so you can click on it and you can see for yourself. You can see my automated commentary analysis of the web page or the particular chart. And I think for all you discretionary traders, that's an example of where I can synthetically or based on numbers only write a commentary every day, automatically generated, that looks amazingly realistic as though I were writing it out myself. So if you're looking for a little amusement on the weekend, you can log in and look at the if you and read the commentary. If you could just click on the analytics tab.
Okay.
Tom.
Yeah.
On the top menu, the analytics tab.
Yeah. Do you see it? I clicked on it.
Okay. All right. And if you, sorry, I see I'm on the wrong screen here, as usual. If you just click on the commentary portion, the CT, the blue line that says just click on the individual. Yeah, just click on that, and see there's a automated commentary, and you can it tells you whatever and gives you a summary, and it's kind of a neat little thing because you can automate the computers to do anything, and here's an example of writing you a summary of what the chart is saying, purely based on whatever is happening internally from a numbers basis.
Excellent. Well, I tell you what, this has been great having you on the show.
Thank you so much.
Yeah, very, very interesting information. It's a different approach, but that's cool. I like having everyone's input from stock charts. We have a lot of great analysts, and you take a little bit different approach, and I think this is a really interesting one as well. No doubt about it. We'll have to have you back on the show again soon for sure.
Oh, thank you so very much. Thanks to Erin and for all the listeners this morning. I hope I haven't totally bored you guys to tears, and hopefully we'll come back and have another go at it.
Well, the question box, the live chat was very lively, so I don't think you put anybody to sleep.
Oh, thank goodness.
Yeah, it was a great presentation. We really enjoyed having you on here, Tushar. And come back again soon.
At the beginning, when you argue before the Supreme Court, you start by saying, "May I please the court?" So that's pretty much I sign off with.
I liked one of your comments earlier where you said you stuck your finger in the blender, because I feel like I've done that many times here.
Oh, don't tell me about it. Pretty soon I'm going to have no fingers left.
There you go. Well, again, thanks again for stopping by, and we'll have you on again real soon.
Thank you so very much.
All right, Erin. Well, we got just a couple minutes here. What are your final thoughts today? I mean, that was an interesting discussion, and certainly, another way to look at the market and the trending of the market, and really interesting to get the feedback there from Tushar. But, looking at the last market update and where the market is now, and knowing we got a non-farm payrolls report coming up on Friday, and we got the Fed meeting next week. What are you looking at?
What am I looking at? I'm still very interested in what's going on with the NASDAQ. I just got a short-term trend model neutral signal on the NASDAQ yesterday, and gold as well. I'm really interested in what's going on with gold because I just got a PMO sell signal and a short-term trend model sell signal. So Definitely bearish on gold. Very curious if those particular signals are going to pan out.
Yeah, I'm kind of watching the 10-year Treasury yield. Of course, I'm always watching the 10-year Treasury yield because
Of course you are.
I like to know what's going on in the bond market because call me crazy, but I think the bond market's smarter than the stock market. So, if I start seeing the stock market going in one direction and the bond market yields going in the other direction, that makes me nervous. And over the course of the last few days, you can see that the yield on the 10-year Treasury is actually testing where it was 3 days ago, which was those the same lows that we hit on the NASDAQ that we retested today as well. So I don't want to see the 10-year Treasury yield going much lower. I mean, that's making me a little nervous here in the near term. And also, as I pointed out earlier, the fact that the volatility index started rising last week before we started seeing the market roll over is a little concerning as well. I think both these issues to me right now are short-term issues. I don't look at them as long-term, but they are something to think about. So anyway, time to wrap up. I do want to thank everybody for stopping by. A couple more quick announcements. Tomorrow, Greg Schnell will join me as Erin will be off tomorrow. But Erin does return on Friday, and she will be hosting a segment on the decision point model. So make sure you're here for that. On Saturday, Greg Schnell and I will be back. We'll be hosting the latest Stock Charts Outlook show, and that will air at 11 a.m. Eastern Standard Time. Haven't talked to Greg. I don't know what exactly he'll be talking about, but I'm sure we'll be looking at what's been taking place here in the fourth quarter of 2017 and what we see going into 2018. So that should be a good show as well. Thanks, everyone, for stopping by. Please, if you have a couple minutes, if you could just fill out that survey down at the bottom right part of your screen under How Do We Do, you can just click there and follow the link. It's a very brief survey, and we'd love to know what you thought of today's show with having Tushar on. So just take a couple minutes and fill that out if you don't mind. As a reminder, Market Watchers Live airs 5 days a week now, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Want to wish everybody a great afternoon. We'll be back tomorrow. Happy trading, everybody.